Vincent Reinhart is resident scholar at the American Enterprise Institute. He joins me now live from Washington. We should mention he's a former director for monetary affairs for the Fed. So what does this do? What is the effect here?
So the general principle is a good one. That is, the FDIC's insurance premiums should be related to the risk of the financial institution. That's a general principle, which I applaud. The problem is it's very hard to map a given compensation scheme into the riskiness of an institution. The FDIC should make an assessment overall of the riskiness and then of a bank, and then figure out what the right insurance premium is. They're going after compensation schemes right now because there's a lot of anger about big banks, and this is one way of expressing that anger.
I mean, as we've seen with anything with money, money's fungible, right? It's going to find its own path of least resistance. That doesn't change when you talk about executive compensation. I mean, can't these pay packages be structured in ways that get around whatever new restrictions are going to be laid out by the FDIC?
No, that's exactly right. And there's three big problems related to it. First is compensation can be very complicated, and this is just an invitation to make the compensation scheme more complicated. If the FDIC staff could figure out at a point in time how a given compensation package translates into the riskiness of an institution, and that's a really big if, it's an invitation to then to change that over time. And then third, it is also, if it really does start to bite, then the institutions will just move the activities where they have to pay employees large sums off the bank balance sheet. And it may be, in fact, harder to monitor and may increase the overall riskiness of the financial system as a whole.
No, the chairwoman, Chair has made the point that really the spirit and the intention of this is to align the interests of employees to manage risk. It's not to set outright pay amounts here. It's not to put a cap, so to speak, on the pay amount. How do you do that? I mean, how do you get employees to take risk really as a concern, if not to hit them most directly and hit them where it hurts the most, their wallet?
No, that's right. But I think, and the general principle of increasing market discipline is a good thing. That is, increasing discipline on the people taking risks. That's a good thing. The problem is you don't do that by making systems more complicated. Actually, a more complicated system lends itself to bringing in the lawyers, writing down a set of rules that will satisfy the FDIC, and actually may divorce risk-taking and monitoring more than where we are right now.
Well, we also have heard that the Obama administration, that the president himself, plans to raise as much as $120 billion by putting a fee on financial institutions to try to recoup losses from TARP. And what do you make of this new initiative? And how do you think that this can actually be carried out, since so many of the financial institutions have repaid their TARP funds, and there may not be that same level of leverage?
Sure. In fact, TARP was a really TARP was had some disadvantages, and the firms that got the funds initially have seen those disadvantages. I would advise the president to connect the dots, right? And if right now they're looking at things to find revenue from the banking system, that's inconsistent with having banks take a more active role in lending and supporting markets. So if they want a strong economy, they want a strong rebound, they better think of ways not to tax banks.
Well, we'll continue to see just what some of those ideas may be. Thank you very much. It was former Fed Monetary Affairs Director, now AEI resident scholar, Vincent Reinhart.